Aetna, Incorporated, is an American managed healthcare company, which sells traditional and consumer-directed healthcare insurance plans and related services, such as medical, pharmaceutical, dental, behavioral health, long-term care, and disability plans. Aetna is a member of the Fortune 100. Members: Aetna offers healthcare, dental, pharmacy, group life, disability, and long-term care insurance and employee benefits, primarily through employer-paid insurance and benefit programs, and through Medicare. Membership numbers: 22 million euro medical members, 14.3 million euro dental members, 13.8 million euro pharmacy members, 13.609 million euro group insurance members, 1 million plus euro healthcare professionals, 597,000 plus euro primary care doctors and specialists, 5,300 plus euro hospitals. Lobbying and campaign contributions: Aetna has spent more than $2.0 million in 2009 on lobbying. The company spent $809,793 between January 2009 and the end of March 2009, up 41% from the same period in 2008. Aetna's campaign contributions include more than $110,000 to U.S. Senator Joe Lieberman in 2009. From 2005 through 2009, Aetna contributed $56,250 to Senator Max Baucus, chairman of the Senate Finance Committee, making Aetna the senator's seventh highest contributor over that time period. Quality of care: in the California Health Care Quality Report Card 2011 edition, Aetna received 2 out of 4 stars in meeting national standards of care and 1 out of 4 in members rate their HMO. In the California Health Care Quality Report Card 2010 edition, Aetna received 3 out of 4 stars in both meeting national standards of care and how members rate their HMO, for a rating of good. Current leadership: Mark Bertolini became CEO of Aetna on November 29, 2010, and chairman on April 8, 2011. Karen S. Lynch is the president of Aetna. Stephen B. Kelmer is executive vice president of corporate affairs and chief of staff to the CEO and chairman, Mark Bertolini. William J. Casaza is executive vice president and general counsel. Richard D. Benedetto is executive vice president in charge of Aetna International. Deanna Fidelris executive vice president in charge of human resources. Sean M. Gertin is executive vice president, CFO and chief enterprise risk officer. Diwana Lewis is executive vice president in charge of consumer products and enterprise marketing. Meg McCarthy is executive vice president of operations and technology. Harold L. Paz, MD, MS is executive vice president and chief medical officer. Fran S. Suisman is executive vice president in charge of government services. Joseph M. Zubritsky is senior executive vice president in charge of Healthigen. Operations: in 2005, the company had $1.1 billion in earnings. Aetna's 2007 revenue, reported in 2008, was $27.6 billion. Aetna's 2008 revenue, reported in 2009, was $31 billion. Aetna's 2012 revenue, reported in 2013, was $35.54 billion. History: Aetna is the direct descendant of Aetna Insurance Company, of Hartford, Connecticut. The name was meant to invoke Mount Aetna, at the time Europe's most active volcano. Timeline: 1810s, 1819 Henry Lavett Ellsworth, Yale graduate and attorney, becomes second president of Aetna Insurance Company, succeeding Thomas Kimberly Brace. Ellsworth, who later became the first U.S. Patent Commissioner, served as Aetna's president for 2 years until 1821, when he resigned, but Ellsworth continued as a director for another 16 years. Ellsworth's brother, William Walcott Ellsworth, also served as a director, as well as the company's first general counsel. 1850s. 1850 Aetna began operation of an annuity fund to sell life insurance, choosing Hartford, Connecticut Judge Eliphalet Adams Buckley, who was a general counsel to the company and on its board of directors, to head it. At the time, Some church leaders and others believed life insurance was sinful. 1853 The annuity department separated from Aetna Insurance to be incorporated as the Aetna Life Insurance Company, with Eliphalet Bulkley as president. 1854 Aetna hired its first full-time employee, Thomas O. Enders, later to become company president. 1857 Aetna moved to new offices on Hungerford and Cone Streets in Hartford. The Panic of 1857 struck Hartford and the nation, causing the closing of all but one bank and many other businesses. Eliphalet Bulkley blocked a move to liquidate the company during the economic downturn. The Aetna Insurance Company issued life insurance policies on an undetermined number of African American slaves, naming their owners as beneficiaries. 1860s 1861 Aetna began offering participating life insurance policies which paid dividends to policyholders just as the mutual life insurance policies did. Aetna launched its new product with a promotional effort including higher commissions for its agents while most companies were cutting back due to the outbreak of the American Civil War and the consequent loss of premium payments from Southern policyholders. However, the death toll of the war coupled with the booming wartime economy caused an expansion of the life insurance business to match Aetna's expansion. 1865 By 1864 Aetna had increased its volume of business by 600% over 1861 and its annual premium income ninefold, exceeding $1 million. As a result, Aetna possessed the financial stability and resources it needed to meet the stringent regulatory requirements placed on life insurance companies in Massachusetts and New York. By 1865 the company was authorized to begin soliciting business in these states. 1867 company income rose from $78,000 in 1861 to $5,129,000 by 1867. Aetna moved to its third home office at 670 Main Street, Hartford. By 1924, Aetna had $94 million, 43% of its assets, invested in farm mortgages. 1868 Aetna altered its business practices, hiring its first actuary and abandoning the half-note premium system in favor of an all-cash premium plan. 1870s 1872 Eliphalet A. Bulkley died and Thomas O. Enders became president. 1878 Aetna increased its capitalization from $150,000 to $750,000. 1879 Enders' failing health forced him to resign and Eliphalet Bulkley's son Morgan G. Bulkley replaced him. 1880s 1888 Aetna outgrew its old offices on 670 Main Street in Hartford and purchased its fourth home office, next door at 650 Main Street. The first building Aetna actually owned, and Aetna's home office for the next 42 years. 1890s 1891 Aetna issued its first accident policy, purchased by Morgan Bulkley himself. 1892 Aetna held its first General Agents Conference in Chicago. 1899 Aetna became one of the first publicly held insurance companies to enter the health insurance field. 1900s 1902 Aetna created an accident and liability department to offer employers liability and workmen's collective insurance, in reaction to the growing strength of the progressive social reform movement. This would become the cornerstone of the Aetna Accident and Liability Company. 1903 An Engineering and Inspection Division was created to improve workplace safety. 1904 Aetna introduced its first corporate seal, conveying Aetna's status as the largest life insurer in the world writing accident, health and liability coverage. The logo portrayed the company's home office bursting out from within a globe, with large block typeface spelling out Aetna's ranking. 1907 Aetna created a casualty subsidiary to handle items such as automobile property coverage. Aetna soon began aggressively expanding into related lines such as collision and damage. This business developed into the Aetna Casualty and Surety Company. 1908 Aetna hired its first home office female employee, the first of what has become more than two-thirds of Aetna unregistered trademark S employees. 1910s 1910 Under the management of E. E. Kamak, Aetna began using Holrith punched cards machines for tabulating and hired 35 women to input mortality statistics on key punch machines, the company's first female home office clerks. 1911 Aetna began its first national advertising campaign. The same year, Aetna formed a bond department to market fidelity and surety coverages. 1912 Aetna introduced the first combination automobile policy, with several separate types of coverage combined into one contract. Several Aetna insureds were killed on the RMS Titanic. 1913 Aetna formed its second affiliate, the Automobile Insurance Company, to write fire insurance on cars. This soon expanded to include windstorm, tornado, leasehold, and ocean and inland marine insurance. Aetna formed a group department to sell group life insurance, one of the first insurers to do so. The first step towards Aetna unregistered trademark current healthcare business. 1960s, 1960 Aetna expanded outside the U.S., buying a Canadian company, Excelsior Life Insurance Company. In 1968, it bought a majority interest in Producers and Citizens Cooperative Assurance Company, of Sydney, Australia. In 1981, it bought a 40% interest in two Chilean companies, and soon thereafter invested in ventures in England, Spain, Hong Kong, Taiwan, Indonesia and Korea. 1970s, 1970 Aetna's pension, casualty and life division under the direction of P. E. Burton, president and lead actuary, saw billion-dollar growth in the post-ERISA pension administration segment that placed Aetna in the top 5 global pension and investment asset management and record-keeping firms in the world, with over $11.8 billion in new sales and assets under management during the decade. 1990s, between 1996 and 1999, Aetna initiated a series of company acquisitions. In 1996, Aetna acquired U.S. Healthcare, founded by Leonard Abramson. In 1998, Aetna bought Milcare Health Plans for $1.05 billion, adding 2.2 million members. The next year, it bought Prudential Healthcare for $1 billion, making it the largest provider of health benefits in the U.S., with more than 21 million members. The company spent more than $20 million that it received in fees and premiums from customers to revamp its computer systems, enabling the company to identify and discontinue unprofitable accounts. With this new and extensive information about policyholders, new management, and a shift in strategy, Aetna sharply raised premiums on less profitable accounts. Within a few years, Aetna shed 8 million covered lives due to premiums that customers could no longer afford. 2000s, 2000 Aetna hired John Rowe as CEO and executive chairman. Rowe cut approximately 15,000 jobs and raised insurance premiums by 16% per year. He also shrunk Aetna's customer base from 19 million members to 13 million by abandoning unprofitable markets, including almost half of the counties nationwide in which it offered Medicare products. 2000 Aetna sold its financial services and international businesses to ING for $7.7 billion, spun off its health business to its shareholders, thus focusing its business as an independent health and group benefits company. 2001 Aetna recruited global public relations and marketing executive Roy Clayson, Jr. to lead the company's reputation management strategies during Aetna's multi-year corporate turnaround campaign. 2006 John Rowe ended his 65 months as CEO and executive chairman of Aetna. During his tenure, the former Harvard geriatrician earned $225,000 a day. 2007 Aetna Chief Medical Officer Troy Brennan told the Aetna Investor Conference that, "The healthcare system is not timely." He cited recent statistics from the Institution of Healthcare Improvement that people are waiting an average of about 70 days to try to see a provider. And in many circumstances people initially diagnosed with cancer are waiting over a month, which is intolerable. 2007 Aetna acquired plan operator Scholler Anderson in July, signaling a push into the growing business of running plans for Medicaid and a state children's health insurance program. 2008 Aetna CEO Ron Williams received $38.12 million in compensation, the highest annual compensation in the insurance sector and the 22nd highest compensation of all American CEOs. 2008 Aetna began offering pet health insurance in Alabama, District of Columbia, Idaho, Iowa, Montana, North Dakota and Texas, with plans to quickly expand to all 50 states. OE as the new underwriter for Pets Best policies, we look forward to working closely with Pets Best and the AVMAGHLIT to extend the reach of the pet insurance industry to bring trusted, affordable pet health insurance products to pet owners nationwide, said Gretchen Spann, Aetna unregistered trademark S head of pet insurance. 2008 Aetna's 2008 revenue, excluding net realized capital losses, increased 14% over 2007 to $31.6 billion. 2009 through June 30, Aetna took in $14 billion in premiums, $10.7 billion of that amount from employers and employees, $2.9 billion more from Medicare recipients who bought a supplemental insurance plan to cover the gaps in what Medicare covers, and another $400 million for handling Medicaid claims. Aetna reported that it paid out $11.9 billion in healthcare reimbursements and $2.3 billion in administrative expenses. On September 22, more than 200 people gathered in front of Aetna's Hartford headquarters to call for a public health insurance option they said is essential to true national healthcare reform. The insurance industry, including Aetna, has opposed a public option. On October 2, Connecticut Attorney General Richard Blumenthal and healthcare advocate Kevin P. Lembo asked Aetna and 4 other insurance companies for information the companies may have sent policyholders regarding the impact of proposed legislation on Medicare Advantage and prescription drug programs. According to Blumenthal, some insurance companies have exaggerated or stretched the impact of healthcare reform. On October 27, Aetna stock values shot up when U.S. Senator Joe Lieberman of Connecticut broke with the Democratic caucus that he is a member of and vowed to join a Republican-led filibuster if the public option was not removed from the Senate's health care reform bill. On October 30, Aetna reported a third-quarter profit increase of 18%. On November 3, U.S. Senator Tom Harkin, chairman of the Committee on Health, Education, Labor and Pensions, launched an investigation into health insurance pricing, asking Aetna and 3 other major insurers to justify their pricing practices. The investigation began after small business owners testified before Harkin's committee that skyrocketing healthcare premiums were severely hurting their livelihoods. On November 19, Aetna announced the layoff of some 3.5% of its workforce, €625 employees now, and a similar number of reductions early next year. The current cuts include 160 jobs in Connecticut. Streamlining our business now will enable us to improve our competitiveness and redirect resources to areas with a greater potential for future growth, said Aetna CEO Ron Williams. During the third quarter of 2009, Aetna earned $326.2 million, or 73 cents per share. That represents an increase from $277.3 million, or 58 cents per share, in the same quarter last year. On November 30, Aetna CEO Ron Williams told analysts that Aetna would increase prices in 2010 and force 600,000 to 650,000 Aetna customers to drop their coverage. Aetna President Mark Bertolini justified the move as ensuring that each customer is priced to an appropriate margin. Aetna Chief Executive Ronald Williams owns 7.6 million Aetna stock and options. On December 7, Aetna filed a $4.9 billion correction to its 2008 health insurance regulatory filings. The new filings show that Aetna spends less on small business healthcare than previously reported. OE health insurance companies have a duty to provide accurate financial information both to consumers and to their regulators about how much money they actually spend on healthcare and how much they spend on profits, on executive salaries, and on figuring out how to deny care to people when they really need it, said Senator Jay Rockefeller, chairman of the U.S. Senate Committee on Commerce, Science, and Transportation. OE Unfortunately, it looks like Aetna and other health insurers have the unregistered trademark been taking this duty very seriously. Unregistered trademark disappointed that my committee had to launch a full-scale congressional investigation to get these companies to meet their basic reporting obligations. On December 14, Aetna stocks rose dramatically after U.S. Senator Joe Lieberman of Connecticut threatened to filibuster the Senate healthcare reform bill if it included a Medicare buy-in proposal. December 29, Aetna chief executive Ron Williams owns approximately 7.6 million Aetna stock and options. The price gain for Aetna stocks of $8.50 from October lows to December 29 adds at least $37 million in value to Williams Holdings. 2010 On February 3, Aetna laid off more than 100 Connecticut workers. This follows the layoff of 160 Connecticut Aetna employees in November 2009. On February 6, Aetna reported 2009 fourth-quarter net income of $165.9 million, or 38 cents per share, on $8.69 billion in revenue. On April 30, Aetna announced a 29% increase in net income for the first quarter of 2010 compared with the same quarter a year ago, as the insurer benefited from higher investment income. In April, Aetna notified policyholders that it was in a contract dispute with Continuum Health Partners and that its contract with Continuum Health Partners would lapse as of June 5, 2010. Continuum Health Partners comprises 5 major New York City hospitals: Beth Israel Medical Center, Roosevelt Hospital, St. Luke's Hospital, Long Island College Hospital and New York and Ear Infirmary. The June 5 date passed and the contract lapsed, an outcome that could mean much higher costs for thousands of New Yorkers. Aetna is obligated in its contract with doctors to retain those doctors in network for a policyholder for a period of a year or until the expiration date of the policyholder's contract, whichever comes first. Aetna did not inform policyholders of this fact. Continuum Health provided a form to policyholders to make this request. U.S. Senator Kirsten Gillibrand has asked executives of Aetna and Continuum Health Partners to re-enter negotiations, saying, "I urge you to re-enter negotiations on a new 3-year agreement for reimbursement rates, for the sake of the patients that need health coverage." In July, the faculty union of Pratt Institute, United Federation of College Teachers Local 1460, prepared a letter to Aetna expressing their unhappiness over the termination of the contract. In June, Crystal Run Healthcare, a 170-doctor group practice in Orange County, New York and Sullivan County, New York, announced that it would terminate its contract with Aetna on July 31, 2011. Crystal Run stated that, "Aetna proposes to pay us significantly less than other commercial healthcare plans with whom we contract. Despite good faith efforts, we cannot come to an agreement at this time. We want to afford every opportunity to our patients to make informed choices regarding their health care coverage." Aetna replied, "It is extraordinary that a responsible physician group would alarm patients in this manner more than a year before there could be any impact to those patients." On July 27, Aetna reported that its second quarter profit rose 42%, as the percentage of premiums the company spent on medical care fell versus a year ago. The insurer earned $491 million, or $1.14 a share, in the 3 months ended June 30. That compares with net income of $346.6 million, or 77 cents a share, in the same period last year. On September 9, Aetna announced that it would demolish its 1,300,000 square foot structure in Middletown, Connecticut that once housed approximately 5,000 Aetna employees on a 261-acre campus. Aetna has not said exactly how it will redevelop the site, although a data center currently located there will remain regardless of future plans. 2012 In June 2012, Aetna and Innova Health System announced a joint venture creating a new health insurance company, Innovation Health. 2015 On July 3, 2015, Aetna announced that it will acquire Humana for $37 billion in cash and stock, or $230 a share. Aetna and Humana shareholders will own 74% and 26% of the new combined company. The acquisition is subject to United States government approval and is expected to close in late 2016. Fines, lawsuits and settlements. 1999 A jury in California awarded $116 million in punitive damages for malice, oppression and fraud to a patient's widow who contended he died after a subsidiary of Aetna delayed approving treatment for stomach cancer that its own doctors had recommended. Lawyers on both sides called it the largest such verdict against a health maintenance organization. In 2001 a settlement was reached. 2000 The U.S. Court of Appeals affirmed a $1,855,000 federal jury award for Brokerage Concepts Incorporated against Aetna U.S. Healthcare, its Pennsylvania subsidiary, as one of its former senior executives, Richard Wolfson. In its suit, BCI accused Aetna U.S. Healthcare of tortious interference with contractual relations. BCI alleged the managed care company used its economic power in the business of prescription drug sales to coerce one of BCI's clients, the I Got It at Gary's pharmacy chain, into using another Aetna U.S. healthcare subsidiary, Corporate Health Administrators, as its health benefits management firm. According to the suit, Aetna U.S. Healthcare threatened to drop I Got It at Gary's from its pharmacy network if the company didn't switch to Corporate Health Administrators. 2001 The Maryland Insurance Commissioner ordered 5 Maryland health plans to pay a total of $1.4 million in penalties for failing to comply with the state's claims payment practices. Aetna was cited twice and ordered to pay the largest fine of $850,000. The state of Texas fined Aetna $1.15 million for failing to promptly pay doctors and hospitals for services. Texas Insurance Commissioner Jose Montemayor also ordered Aetna to pay restitution to physicians and healthcare providers who did not receive timely payment for claims. 2002 The New York Department of Insurance fined Aetna U.S. Healthcare and United Healthcare a total of $2.5 million, citing a litany of bungled claims, improper treatment denials, unlicensed health insurance agents, and poorly performing claims processors using out-of-date software. Aetna agreed to streamline communications, reduce administrative complexity, and improve the quality of the healthcare system, ending litigation between Aetna and 700,000 physicians and medical societies. The physicians' lawsuit, settled for $470 million, charged Aetna with systematically reducing payments to physicians and overriding their treatment decisions. 2003 Aetna and the American Dental Association announced a class action settlement by dentists who accused Aetna of interfering with dental procedures to cut costs and forcing dentists to comply with excessive paperwork. The settlement called for Aetna to pay $4 million to 40,000 to 50,000 dentists and $1 million to the ADA Foundation, a charitable group. Georgia Insurance Commissioner John W. Oxenden fined Aetna's Prudential Health Plan $100,000 for violating Georgia's prompt pay law by delaying claims payments. Aetna companies had been fined 4 previous times by Oxenden's office, in 2000 and again in 2002, for a total of $411,200. 2007 The New Jersey Department of Banking and Insurance filed an administrative order levying a $9.5 million fine against Aetna for refusing to appropriately cover certain services provided by out-of-network providers including emergency treatment in violation of New Jersey rules and regulations. 2009 Former Aetna employee Cornelius Allison of Darby, Pennsylvania, filed suit against Aetna in U.S. District Court in Pennsylvania after hackers gained access to a company website holding personal data for 450,000 current and former employees as well as job applicants. The suit charged Aetna with negligence, breach of contract, negligent misrepresentation and invasion of privacy. The Arizona Department of Insurance fined Aetna Life Insurance Company and Aetna Health, Incorporated after examination of their practices exposed multiple violations of Arizona insurance laws. The department found that Aetna violated significant state laws governing important areas of health insurance operations, including Aetna's failure to provide policyholders with information about their rights on appeals of medical claims or services denials, failure to acknowledge receipt of policyholder appeals, failure to notify policyholders about appeal decisions' outcomes, and, in some appeals involving the denial of services for potentially life-threatening conditions, failure to inform policyholders of their decision within the required, expedited time frames. 2010 Aetna paid a $750,000 fine as part of a settlement with the New York Insurance Department related to the company administering an affordable healthcare plan for the state. Aetna's violations included failing to provide a required 30-day notice of rate increases to about 946 members in 2007, failing to provide notice to 1,406 terminated workers of their rights to convert to another policy, failing to report enrollment data from May 2007 through August 2008, and failing to respond to insurance department requests for data in March 2008. Life insurance policies on slaves. In 2000, Adria Farmer Paulman, head of the non-profit Restitution Study Group of Hoboken, New Jersey, disclosed that from approximately 1853 to approximately 1860 Aetna had issued life insurance policies to slave owners covering the lives of their slaves. Aetna acknowledged that concrete evidence exists for Aetna issuing coverage for the lives of slaves and released a public apology. In 2002, Farmer Paulman brought suit against Aetna and two other companies in federal court asking for reparations for the descendants of slaves. The lawsuit said Aetna, CSX and Fleet were unjustly enriched by a system that enslaved, tortured, starved and exploited human beings. It argued that African Americans are still suffering the effects of 2.5 centuries of enslavement followed by more than a century of institutionalized racism. The complaint blamed slavery for present-day disparities between blacks and whites in income, education, literacy, health, life expectancy and crime. This suit was denied, and the denial largely upheld on appeal. In 2006, Farmer Paulman announced a nationwide boycott of Aetna over the issue of reparations for its policies covering slaves. Aetna stated that its commitment to diversity in the workplace and its investment of over $36 million in such areas as education, health, economic development, community partnerships, and minority-owned business initiatives in the African American community is more effective at aiding descendants of slaves and African Americans in general than making restitutions for Aetna's life insurance policies on slaves. See also: Driver-trainer, health care reform in the United States, health care reform debate in the United States, health insurance, life insurance, managed health care, Medicare Advantage, pet insurance, public health insurance option, reparations for slavery. References. External links, official website, Pets Best Insurance, Quality Report Cards Aetna Plan HEDIS Reports, Restitution Study Group, Aetna Medicare.